Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Tuesday, February 14th, 2023. I'm going to do a brief update on the equity markets. I want to touch on some of the other recently highlighted trade ideas, particularly commodities. I'll get to gold, silver, and anything else that stands out. This may be the only video today. I told you yesterday I had some errands to run. Those errands, just to explain, are I have to still finish my my taxes, not for 2022, it's still 2021. So I had an extension out as I usually do, and they were due October 15th, is the usual extension date, and then the hurricane hit, so they gave an additional extension of those folks, and that is February 15th tomorrow. So I thought I was a little ahead on it once I had started it back in October, but realized I've got quite a bit to do today, in addition to going picking up my wife's Valentine's Day present. So there's a whole story behind that too. So anyways, just want to let you know I won't be getting a lot out to you today, but I should have my taxes wrapped up and back to business as usual. Let's dive into the charts here. NQ, NASDAQ 100, we're right back to where we were this morning. We spiked on the CPI number. It came in a little hotter than expected, and it just shows that the rate of abatement is slowing. In other words, again, we can track commodities. We'll get to that in a second with oil, gas, and general commodities ETFs, and kind of get an ebb and flow, at least where that component of inflation is. Services, home prices, all that, we can extrapolate pretty easily based on interest rates. We had that pullback in rates, which we foresaw, we caught, we traded, after the big spike in rates that really put the brakes on the mortgage market, and so you had that surge. And again, it's going to be, I believe, a vicious cycle, negative feedback loop, as I've talked about, where we'll have these periods where the market, whether it's real or perceived, an abatement in inflation, which coincides with expectations that the Fed will either stop hiking rates or start cutting rates, and then the stock market will rally on that, and then there'll be the reality will set in that, hey, this is a more of a secular upward trend in inflation, not just a brief, post-COVID spike. All right, let's get to the charts. So again, objective shorting entry, but it's not an all-in moment. I'll point out objective long and short entries on trades, and anytime I see them. And so there's that small, it's not very big, but it sometimes doesn't take a lot. You do have negative divergence, and we're right there now. So if you missed it this morning on that initial knee-jerk reaction, we still have an objective short entry here. You have the primary downtrend line and a back test of the downtrend line off the recent highs, I should say. That's not the primary bear market downtrend line. It's a smaller, but significant on this time frame. And then look, there's I'll say this, that there is a bid underneath this market. There obviously has been for a while. Remember that when for the markets to go down, it takes an overwhelming shift in supply demand dynamics, because the whole machine, Wall Street, is inherently bullish. The vast majority of participants, fund managers, individuals, institutions, are long only and bullish almost all the time, and they should be, because typically the economy is growing, the stock market's going up, and therefore pension funds and hedge funds, and especially mutual funds, long side only, that don't have the opportunity to short, they have to buy stocks. They can't sit in cash forever. Fund managers, growth fund managers, buy prospectus, must be fully invested. So in other words, we have to be quick and nimble on the shorts. And right now, I maintain this is an objective short entry. And I continue to waffle on the fact: are we going to still grind around for a while longer? We've already ground around for a couple weeks sideways, or is this going to be it? And again, it's not an all-in short moment for me, but it's certainly an objective short entry here. That's it. Let's leave it at that. Stops would be commensurate or in line with where you think things are going. I can't speak to everybody. I can share my opinion. I think there's a decent chance we're at the tail end of a bear market rally with another leg down to come. And that may have been the end of it right there, or at best, I still think best case scenario, we get one more thrust up, let me show you my primary board, my busy board. Remember, all the way back here, off this low back here, I laid out two bounce target zones. A red one called the most likely bounce target zone, where which was most likely to cap the bear market rally. In other words, we're most likely to get at least to the bottom of it, or to the top of it, somewhere in between. And then I laid out this purple one, which I said would be my max bounce target zone, really, where if this is a bear market rally with another leg down to come in the bear market, this would be the uppermost level. Anything much above there doesn't mean that the bear market, that we can't go and take out these lows. It just reduces the odds, because that's when you look at it from a very simplistic point of view, you have this major reaction high, and you've also then at that point gotten really far away from the 200 days, and you've probably taken back on the long-term charts. I'm not going to get into those today, but some key averages, the long-term moving averages, trend lines, and other things like that. So again, it's just this stuff is more of an art than a science, but that's my views. And so now back to where we're at. Let me go to this other board, what I call the clean board with fewer lines, and this is what we're going to go through. So we're still watching. I've highlighted these potential, but we still don't have the bearish crossover on the Nasdaq 100, which is important. That's the index to watch. If I could only watch one and trade one, this would be it. But I like to, as you guys know, I like to watch them all. Sometimes trade them all. But we don't have that. That histogram would have crossed red. So we've come close so far, and then sometimes it appears, and you do ultimately get that crossover. You're heading down, the cross looks imminent like it did there, and it was imminent. It just had a little brief abatement. The lines kissed, crossed, and then the bearish crossover came right there. And then the top was, in percentage terms, it didn't nail the top on the day, but it in percentage terms, you were there, within a percent or so. And again, I've gone over this numerous times. Sometimes there's whipsaws on the bullish side too when you get the bullish crossovers, but these are the major trends. And bear trend, bull trend, bear trend, you can see it like that. And they're fairly regularly spaced. And this was a fairly longer than usual bull trend. This was a shorter than usual bull trend. But you can see this is this is the markets. This is swing trading. We go up, we go down, we go up, and then over time you start to see, which we clearly see now, that the longer term trend is bearish. And therefore, when you can sit there, and I can do it all day long, make a bullish case, make a bearish case, but you give the benefit of the doubt to the trend. So right now, the fact that we have taken out these previous spike highs goes a little bit into question. But again, there's always, we took out that previous spike high right here, and there was still another leg down. So kind of bigger picture still shows us zigzagging down. And I don't want to put too much of an emphasis on these higher highs, higher lows, because you could do this. I mean, if you really want to look at it that way from a big perspective, you go out, let's say, to the weekly chart, turn off all the lines. I'm just trying to make a point that the trend, the higher highs and higher lows is somewhat important. But let's just say this is the bigger picture. A big wave leg down, we come up, but we fall short of the highs there, and then we go on down. So that's what it would look like, still being in a secular or larger bear market, but with these bear market rallies within there, and even taking out that previous reaction highs. So remember, there's no hard script as to how this bear market plays out. And in fact, I've maintained all along, I think this one is going to play out a lot different from the others in recent history. And that's why for example, why I'm a bit dismissive of the breakout above the 200 days and the downtrend lines. Not only, again, that we've spiked above the 200 days before, but in previous bear markets and in this one. And again, there's a lot for the bulls to see here with that primary downtrend line being taken out on SPY, QQQ, IWM. All the indexes have taken out the primary downtrend lines in the 200 days. But again, so it's if you're going off the script of 2007 to 2009, that bear market, or even the one back in 2000 to 2003, those were our last true bear markets. Then yeah, time-wise, this bear market should be over by now, right? Or close to it. Those bear markets were just over a year and a half, something like that. And this one's now getting, coming up on, not quite there yet. So again, how we trade, and go forward. I'm kind of taking it day by day, but let me just show you and kind of wrap this up and move on to the next one. So again, you have, this is busy board, that other potential target zone, but I'm just going to go back here and not show it. So, we've seen there are times where these bearish crossovers either look like they're going to occur and then it gets delayed like it did from here to here, and then the top was actually there. That was just measuring it when it looked like it was about to cross. In other words, right where we're at now. Remember, I showed you the histogram, still green. Last 2 days, these lines have flattened out. We're right on there. Look at the PPO. Wanted to cross, but it hasn't crossed. So, that's so far. It would just be another check mark if and when we get it. And there's right there, it looked like it was going to cross, but the top didn't come. It did ultimately cross, and I'm measuring out that's 14 calendar days or 10 bars, which means 10 trading sessions later it came. So again, it's a matter of, is it going to come now or do we get another thrust up? Let me point something out here. If we get another thrust up, and we take out, just like I was looking on the 60-minute chart, but let's say we do it here on the daily, and we take out this previous reaction high right here. I'm going to draw it. That would be your line. It would look something like this. Maybe we continue to back test this trend line or even pop through it, like we did right here. I think I have that. Was that on spot? No, it was right here on QQQ. You can see this. We had an uptrend line on that last top right there. It was a pretty clean uptrend line. We broke down below it. We had a sell signal right there, right? After getting rejected off the bottom, that resistance there, the bottom bounce target zone, but then put in a marginal new high. We also, that candle closed green. We took out the trend line there, but then boom. So that would be similar. I'm going to draw it here. That would be similar potential scenario, and that's why it's just not an all-in moment for me. Certainly not an all-in moment. I mean, this market could do more than that, but that's a very likely scenario, quite likely, and that would blow out a lot of short interest. I just don't know if we had enough. I think there are a lot of folks looking to short this rally, and we got a nice pullback trade. But look, we hit a lot of support, and we still have. We hit support and still have a lot of supports. I color coded these up. Remember, about 296.50, give or take. That's price support right there. Then you have the 200-day exponential, the 200-day simple moving average. You have the primary bear market trend lines from the highs there, and that's of course on QQQ. So this is a whole confluence of support right there that has to be taken out in order to sharply increase the odds that we're going to do this. Take out the old lows and have a drop. When I'm talking a swing or trend trade of 10% plus, that's worth getting out of 401k monies. If it's to the downside, or a 10% plus on the upside is, in my opinion, worth getting into those longer term swing or trend funds. Active traders, like I said, are gonna, when you get in these choppy sideways ranges, you got to be very actively trading. I talked about this a couple weeks ago. I said that I predicted that swing traders, if you're trying to swing trade this market, you're going to get frustrated because I suspected there's a good chance we could grind around, and that's what we've done. So, whether you're bull or bear, and if you were a typical swing trader, looking to get 10% or plus on a move, you've been frustrated. You've gone nowhere. You went up, down, and that may continue to be it. Or, hey, we're in a bear market. Maybe all these technicals work. We took out this uptrend line right there. This is the second back test. We back tested it yesterday, back tested it again today, and that downtrend line. That's the same downtrend line I gave you on the 60-minute charts of NQ. That's this morning on that post, and I just started the video out. So there it is. There's a lot of resistance. So again, a case can be made to be short, and if we go up higher, that would be really the last. I'd want to see a marginal new high, then a reversal, put in some divergence possibly on the daily there, and that's it. So let's see, if we start moving lower, start taking out these moving averages, then I think it makes sense to add on to some swing shorts. But even the bull case might want to see. I'll tell you, it'd be better for the bull case to see a little washout move, another move down here, maybe a back test to the 200s, and then go up there and then take out the divergences, go way beyond that previous high. So it's not just a marginal new high, because that tends to be where tops come from. They take out the previous highs like that, boom, 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 and then boom. That's it. So, anywho, lot there. Takeaway is it's just not an aggressive short or an aggressive long moment. And I'll maintain what I've also said. I've been saying this for the last week or so. I think at best we grind around, the upside's limited. So like I said, if you were an options trader, you could sell covered calls. Let's say you're bullish and you want to hold on to your Amazon and your Alphabet and whatever else, Tesla, you think they're going a lot higher, you think the bear market's over. You could sell covered calls. Calls up in here where we're not likely to get to, which are going to expire worthless. That's covered call selling. You own the shares and you're generating additional income, and that's a good strategy when you do expect a trading range or a position. Of course, if they go down, well, you've lost money on your shares, but then you've also generated some income on the puts that you've sold or calls that you've sold. All right, let's move on. SPY. S&P 500, purple lines again. This one, you can see a little notation here. I tweaked this one today. I had it a little tighter before, but this is my redraw. I moved this line. I had it up I think like this, that showed us breaking down and back testing, but I think now this is a better line. It's a better fit. You can see we have couple reactions there, a couple more there, and then this one right here. Tighten that up a little bit just to catch that candle from was that Friday's candle right there. And just like the NASDAQ 100, pushing up against a downtrend line as well. So this is where, ideally a bear should step in and then take out that trend line. And then again, you can see just a massive confluence of support. The 200 exponential and simple are coming in right here. The red line is the exponential, about right there. The 200 simple is right there. This is our primary downtrend line, which is very clean on the S&P 500. By very clean, I mean there's no violations. I don't have to draw BOD or benefit of the doubt. It's just boom, 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 and then breakout. So right now, like I said, take a breakout. If you want to give it on face value, that's bullish. And it is bullish unless it fails. If it fails and we go down there, if we go down below this point right here, we've now failed the breakout above the primary downtrend line. Very bearish. Any pullback should be bought up by the bulls. We've also broken down below the primary uptrend line off the lows, very bearish, and we've also failed a back test of the 200-day moving averages, uber bearish in my opinion. All right, so that's the all-in short moment. That's when it doesn't mean 100% of my portfolio. Still trade other things, and let's get to those other things. So there's the thoughts on the market. So like I said, worth a shot to be short right now, based on the fact we are in a bear market, and that gives us pretty good odds that we're probably going to have another leg down in the coming weeks to months, whether we get a little more upside or not. So kind of a scale in moment. All right, the other things out there. Let me just do an update on the GDX. We're very close today, and I think it makes sense now to take profits. I gave you 2 targets on the GDX short. Remember, I'm longer term bullish on the miners, longer term bullish on gold. These were, targets on the way up, T1, T2, 3, T4 is up there, and I still think we'll hit it, but this is just I think a bull market correction, breakdown back test. T1 was right here. T1S means, so I can differentiate between long and short targets. 3009, that was hit, and as we usually do, there was a reaction. Reactions come in the form of on the way down, you either bounce or consolidate on that support. We did a little of both. Broke down. T2 that I laid out here was about 2850. We could get there, but on the way up, remember this was T1 right here. This was a target, was resistance, and that level's about 29 right there. We're very close. In other words, the RR is not that attractive anymore. And let me show you what's giving me some pause on the futures of gold and silver. I wanted to update that for you. Let's start out. Well, here's silver. All right, silver. This is just 3-month chart, hourly candlesticks, but you have. I'm not crazy about the downtrend line, but what I'm looking at here is divergence. We've had pretty strong positive divergence, and there's some minor support there, about 2160 right there. I could see enough reactions there. If I went back farther, it would probably show a little better. So you have silver at, most importantly, with some pretty strong divergences, and the larger trend is bullish. Let me just jump out to a 6-month, 2 hours, see. We could very well continue to work our way down, and we could also burn through the divergences. There's an uptrend line that's still a potential target. There's price support, really good support, just above $21 right there, around 21, and we may work our way down there. And if we do, we'll still have that divergence if we get there soon. In other words, if you do, it depends how soon, but if you do come on down there. But I think the downside is minimal right now in silver, to the tune of about, in a relatively speaking, remember silver is more volatile than gold. That's about little over 3% or so to that 21, and maybe we zigzag down there, or maybe at any point. That's the thing about trading corrections in a larger bull trend, is don't stay too late to the party, because once they're over, buyers start gobbling it back up. That was where we broke down. Remember, right there in silver, we consolidated, had that little topping pattern there. So I don't know. My convictions aren't super high. I just wanted to point out those divergences are there, and might be a good time to book profits on that GDX. We just made a multi-week low today, so we're not far off it, and right there where we were about yesterday. So that's it. Let me show you gold too, GC. And then I'll get to the charts of the ETFs. GC, where are you at? I've got my chart down here somewhere. GC, there it is. Okay. All right. So on GC, gold futures. This is a 6-month chart, 2-hour candles. Primary uptrend line right there. Beautiful trend line. Negative divergence. This is why we, or at least I recommended, maybe get out of your longs and short for a pullback. A little break there, then a break of that support, and, trend line break. We zigzag down, a little consolidation. Downtrend line, like I said, it's just like silver. I'm not super crazy about it, but it's there. Could prove to be a wedge, but what I can tell you with certainty is there's positive divergences, pretty strong positive divergences, just like we had positive divergences at this low back here. So, and just like we had negative divergences at this high that sent us down. So that's it. And at support as well. So a pretty good case can be made to not only cover the shorts, but maybe get long. I don't know, mixed feelings. I don't have super strong convictions about this either. And again, last couple of days, yesterday at least my head was in taxes. So I'm just showing you levels to watch, and just maybe, and the one thing you can do too, if you think there's more downside, and I like to do this if I'm not sure, I'll just set a stop. If I'm short, for example, I'll set a stop just above the recent highs, and just, if it keeps going lower, periodically ratchet that stop down. You can use trailing stops too. I'd like to manually move my stops up and down, but that's just me. GLD on this is my daily chart. It's busy. I know it's got a gazillion lines on it, but that was the uptrend line that we shorted. That was our confirming sell signal right there. That solid breakdown above the trend line, solid close. We even took out the 178.39 level, and then drifted down. But you can see here I have a support zone, and that may be it. I think there's a decent chance that could be it in gold. I don't know. I just don't know right now. So therefore, no reason to be short, or especially adding to shorts now. I mean, goodness, if you didn't short the sell signals we had, I'm trying to wait for my lines to populate, including this was that comparable level on silver futures right here. Remember that trading range we were in? And then boom, the silver futures. That's why I like to trade the futures. When you trade ETFs, the big moves often happen at night. The breakdowns and the futures, trigger that sell signal, and you can get in or get out if you have a stop loss order. Let's just say you're long and bullish, but you respected this range. You would have gotten stopped out early, but on the ETFs, you wake up to a big gap down because the futures tank overnight as gold and silver trading around the clock. So, but I do want to say that silver, that was a target I had there. I said this was my max target, 1911. Still a decent chance we can get there. Remember, we had this uptrend line, negative divergence, broke down, went sideways. So we either reversed here at 1982 or one more thrust down, in my opinion. And so again, to me, the RR is just not worth it. Why try to milk out another 4%, not even 3 3/4, and risk a sudden reversal? So there's my thoughts on gold and silver. So let me show you the other ones. I know that natural gas was a hot topic lately, It's, all the sell signals we got are still in play. We're just not going, and we're not going anywhere. But that's also something to watch. You have this little range right here. We've now stopped going down, and that's reflected. We had our bullish crossover recently on the PPO right after the breakout. So we broke out above the primary downtrend line. Still a buy signal. These are still the targets. And then on the 60-minute chart, if you zoom down, you can see I just did a little circular box right here. Kind of it's more of the resistance is that circle, but if you want to be safe, you can make it a square like I had it on the daily chart. That's a safe bet if you're planning on adding and waiting until it takes out that previous high right there from back on February 7th. And it could, grind around. And keep in mind, I say this 1,000 times, it's worth repeating. On leveraged ETFs, the longer you grind around sideways, the more the decay is going to work against you on leveraged ETFs. So far, this is not that explosive move I was looking for a few weeks back, and at this point, we could continue to grind around. So if you are long and you don't trade futures, I think UNG is probably the better bet, because this is not, we could grind around and you're going to have a lot less, if any, decay. There's no leverage in UNG, although there's, over time it kind of has expenses and all that. But so that would be and then why not? Natural gas is, I don't even know why they make the leverage ETFs. I'll mention them times because of explosive moves, they're fun to be in. You can do better than the 2-time leverage or whatever it is. But natural gas is so volatile, you really don't even need a leveraged ETF or ETN, because it has so much juice in it. Just these daily moves and the short-term trends are well into the double digits. Alrighty, a few more, and then we'll wrap this up. Still like the the commodity whole arena getting back in for the next leg up thing, and that would also play into my outlook for the stock market. That the market cheerleaders are out there declaring victory on inflation. The Fed won, and now it's a matter of not if they're going to, whether they're going to stop cutting rate or stop raising rates, excuse me, but when they're going to start cutting. That's been the big talk lately, and rightfully so. These commodities are, as I've highlighted many times, in a early stage. What appears to be, when you go to longer term charts, especially, this was a big bear market. All commodities fell from 2000, and really most of them peaked when the last bull market ended about 2008 or so. They went down, but they stayed in a bear market until COVID, and then they all been going up. And so again, I'm maintaining the view that we are in early stage bull market action, and as such, time to start maybe nibbling back on getting back into some of these. And I like to trade them selectively. You can buy a broad-based commodities ETF or ETN, but looking at wheat still looks good. You had the bullish falling wedge pattern there, breakout, but we're right at that first target. Call it resistance, really more of a resistance level. It's not enough to book profits in my opinion. Right about $8. So if we can pop that, boom, 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 run up, make another run at the downtrend line, and eventually, and that's also resistance. Zigzag down and then finally break out and continue the rally there. If you trade the futures, that would be ZW. I'm not going to go over each and every commodity, just some of the ones I've highlighted recently, like this one. There's that comparable level. It's at 800. That's 799 and 3/4. So I'm rounding that up. That's 800. We need to pop. This is a 6-month, 2-hour candlestick chart of ZW wheat futures. That was our bullish falling wedge. There was our positive divergences and breakout. And kind of like natural gas, it didn't rocket off right away. It kind of consolidated after the breakout, but has since took out that high and moved up, hit this first target. And of course, if you're trading futures, that's an objective time to take profits. Futures are leveraged by nature, and you made a pretty penny if you. And this was also a buy signal back here I talked about. We went on, and that one just made a marginal new low. But either way, there's your next target up there at 847, and we need to pop, solidly take out that 800 level, as well as what I just told you on $8 on wheat, the ETF or ETN. WEAT, just drop the H. Alrighty, the still liking the hooved creatures, particularly lean hogs. Again, just a way to be diversified in different things. It's not really doing much, and since I first highlighted, it went down a little, but it kept that divergence in place. That's HE. And you have, and there's not, to the best of my knowledge, we don't have an ETN or an ETF. The closest thing is cow, COW, that has live cattle and lean hogs in it. So these are hogs. Cattle actually looks like it's probably poised to pull back, but bottom line is we had that positive divergence there, but it got extended. The divergence is even larger. This is just 2 months of price history, 60-minute candles. But this is that kind of has been and is resistance around 87.42 or so. And it's not a hard, super well-defined level, but good enough. And I think if it pops that should open the door for a move right up there to my first and then ultimately second targets, minimum targets, and maybe more. But so while the hogs look good, they've been lagging behind, and cattle, live cattle is LE, and that one looks poised for possibly a correction here. Let's see here. So this is a 6-month chart. Let me center it for you. 6-month chart, 2-hour candlesticks. This is a primary trend line, which I think is a nice target. You have the primary uptrend line, price support at 162 right there. And here you have, live cattle's been strong, with the inflation trade roaring on, multi-year highs. Or multi-month highs at least, and there's a 60-minute bearish rising wedge with negative divergence. So if we pop that wedge, you have minor support here at 163.374. Probably get a reaction there and then move on down here. So it's not a monster trade, but it's and if that larger trend line gets taken out, we could fall down all the way here, that 159.77. So just a trade idea for you there. And with wheat. It goes without saying that the other grains tend to run with it. Corn's waiting to just break out above this downtrend line right there. They're still holding on the uptrend line. It's pinched between the apex. This is a symmetrical triangle, and you can see price compression here like a coiled spring. So if we get that, which is what I'd favor, corn could run, and that you'd want to see that happen, especially with wheat. And then the other grain of soybeans. SOYB, same thing. You have this downtrend line and the uptrend line giving you a symmetrical triangle. Upside break should be bullish and take us up in the next leg up in soybeans, which really flirting with the highs back here from 2012 as well. That could be a powerful breakout. And again, the takeaway is a lot of folks aren't watching this. I'm pretty sure, I don't watch a lot of TV, but I'm pretty sure they're not talking about soybeans and wheat futures on CNBC. Could be wrong. So we watch these, we trade these, and it gives us some insight. Even if you don't want to trade them, keep an eye on commodities, because again, that's going to be, inflation is everything in this market right now. It's going to give us an insight to what the Fed will have to do. There's positive divergence on DJP. That's my broad-based commodity ETF right there. It has it all: oil, gas, metals, copper, silver, you name it, gas futures, everything. And this is the inflation trade. This is what it looks like, folks. This is, you can roll back, turn off all the lines, and this is the bear market I was talking about. Commodities started in 2008. This is a bear market. Commodities usually go up when the stock market goes up, but for some reason nobody wanted them because inflation was low. And now that we have inflation, this to me again appears to be early stage bull market action since the low in COVID, ultimately with another leg up most likely. And if that happens, then again that's going to be bearish for the stock market. That dovetails with all my analysis on interest rates, treasury bonds, long-term secular trends, things like that. So anyway, we need to see that downtrend get taken out right there, and that should pop commodities if that happens. Oh, last but not least, I'm going to loop back because I forgot to talk about Mr. VIX when I went on the stock market. So here's that NQ chart I started with. Remember, you had a chance this morning on the CPI print, and then another chance right as I started the video to short that. So at the very least, for a short-term pullback trade, but again, Then you go to the daily charts and you decide whether you want to, swing for the whole enchilada, swing for the fences with a, adding on, scaling into swing and trend shorts that might take us down to new lows in the bear market, or you want just quick pullback trades, and then I'll follow up with some targets later. But let me show you the VIX. So this is that 60-minute chart right here. Nope, 2-hour candlesticks, 6 months of price history, and just accidentally moved it. There it is. We're back testing pretty much. There's the downtrend line. We had that breakout. Remember, I kind of smelled a little, that marginal new high in the market, which would have brought the VIX down, which it did. And so the VIX is now, right now, as I do this video, we're at 1978, which is right here. We spiked through there, but ever so briefly. Let me zoom in for you. You can see it nice and tight. And so this is it. This is, you have the stock market, and far from mere coincidence, I've done this long enough to tell you that when the stock market, like I just showed you in the NASDAQ 100, is at resistance, or rallying into resistance, the VIX is usually at support, especially at those key junctures. So this is it. I can say that. It's not the end of the world, be all end all, but this is where ideally the bears need to step in and take the market down, the NASDAQ and the S&P, and that should cause the VIX to go up again. And then what you have is a breakout, simply a breakout and a back test. Now, we fall much below there. You've also taken out the uptrend line, and there's no guarantee as to what the stock market's going to do, but again, it's hard to spin that as anything but near-term bullish. That would probably mean, let me show you here. I have a, let me show you this chart of the VIX. It's delayed a little bit, but it'll show you the same thing. It's delayed by 15 minutes on this program, but we're right there where I showed you. There's the primary downtrend line. There's your bullish falling wedge. There's our breakout back test. So this is what ideally the bearish case should have us doing, is the stock market reversing, closing red today. The redder the better, I like to say. Get a rejection off those levels, and the VIX start to come up, especially if we can take out these highs and hold that level. However, if we fail this breakout, especially if these divergences get taken out, and then you have the increased likelihood that the NASDAQ 100 and the S&P 500 are going to rally on that, and failed breakout on the VIX, and then maybe go up and put in that divergent high in that rally. Just so you know, if you are short scaling in, it's not huge, but it could be easily 5%. And look, there's no guarantee that if we go up 5% that we're going to reverse. So just keep that in mind. But if you are, the takeaway is, if you're of the mindset I am, and I think, and you think it's, we could flounder around, but it's also a good time to start scaling in because the upside's limited, then it kind of helps you lay out the plan. How do you want to scale in? Where do you want to scale in? And remember, we may not even do that, again, assuming I'm right, and this is what's going to happen. And so therefore, you also have to have a plan. Where do I scale on the way down? And that kind of goes back to what I was showing you before in the beginning of the video. And you have each of these check marks, these purple levels, moving averages, 200-day moving averages, price support levels, and bearish crossovers. The more check marks you get, the more confident you are maybe to continue to layer into those swing or trend short positions for the next move down. And I haven't even talked about the targets. So there's no reason, if you are of that mindset that the bear market's not over, and we're in a bear market rally that's at or near its end, and we're going to go down, then at this point in time you're talking probably another 20+% drop. There's my targets from before the bear market even started officially, or right after it started. I laid out 1, 2, 3. I give you 4 targets. Maintained them all along. That fourth, the next target, is at 235, about 235 on QQQ. But I also had in the blue uptrend line, so we're closer to the blue uptrend line, or will be if we reverse now. And that's still, the blue uptrend line goes all the way back to the right here. It's not the lows in 2009. It's this. Thicken it up here so you can see it better. That's the one right there. And but that would still be, if hit, if and when, and that would come in for another test of the lows. That's about a 15% drop, 14-15%, probably at least undercut it intra-week, might be my guess. And so that kind of tells you, okay, if you're shooting for 15 to maybe, if we shoot through it, 23%, then you can use RR, a stop loss, I'm sorry, of 5 to 7% would give you a 3-to-1 risk reward ratio. You're risking, 1 unit of loss or $1 loss. In other words, 5 to 7% if we go up, to make 15 to 21% on the downside. So that's how it works, and that's that's an attractive RR. Over the years, that used to be my kind of gold standard for trades, and I've morphed more to a 2-to-1 RR at times, especially when my success ratio is higher. When I'm batting, well over 500, on my trades, then I can even quite often I'll use wider stops, and I find that often my trades work out better then, even though I'm allowing a bigger loss if I'm stopped out. Part of it has to do with the algos and the way the markets have evolved. They know where the trader stops are, and they often will run them. And so, after you've had enough stops just barely clipped to see your position after you get stopped out turn around and go on to play out exactly as you thought it would, then you realize, okay, well, the algos have figured that out, and so that's where I try to anticipate, what would cause the maximum pain to the most amount of shorts. And I don't know, maybe we already had that. So I'm going to wrap it up here, guys, get the video out to you, and like I said, I got a whole bunch of stuff to do today. I'll do my best, if anything big happens today, to do an end of day video. Otherwise, this might be the last one. This has been Randy Finney with Right Side of the Chart. Have a great day.